All right, let's get right into it. Today we're talking about an absolute legend in the investing world, the SPDR S&P 500 ETF, but you probably know it by its ticker, SPY. This was the one that started it all, the very first ETF, and it totally changed the game for millions of people. So, let's pop the hood and see what it's all about.
So let me ask you a question. What if you could own a piece of Apple, Nvidia, and Amazon, plus hundreds of other massive companies, all with a single click? Well, that's the powerful idea behind an ETF, and SPY is the original. It's about getting a slice of the biggest names you know and trust, made incredibly simple. So here's our game plan. First, we're going to talk about the big idea, owning the entire market. Then we'll look at what's actually inside the box. After that, we'll check out its performance report card, talk about the price of admission, and finally, we'll tackle the big question: is SPY right for you? Okay, first up, owning the entire market. It's easy to take this for granted now, but before SPY showed up in 1993, the idea of just buying the market was really complicated and super expensive for the average person. This fund was built to solve that exact problem. So what is it exactly? The best way to think about SPY is like a single shopping cart, but instead of groceries, it holds a small piece of 500 of the largest and most influential companies in the United States, and its one and only job is to perfectly mirror the performance of the S&P 500 index. So when you hear on the news that the market is up, they're almost always talking about the S&P 500, and SPY's whole purpose is to go up right along with it. All right, that's the big idea. But now for the really interesting part. When you buy one share of SPY, what are you actually buying? Let's get into it and see what's really driving this thing. And wow, the first thing that jumps out is just how concentrated it is. I mean, look at this. The top 10 companies alone make up nearly 40% of the entire fund. Think about that for a second. That means the performance of just a handful of corporate giants has a huge, huge impact on your investment. The other 490 companies just fill out the rest. And who are these giants? Well, no surprises here. It's a who's who of the modern economy, completely dominated by big tech. We're talking Nvidia, Apple, Microsoft, Amazon, Google. You get the idea. It's the Mount Rushmore of tech. But you also get other major players like Tesla and Warren Buffett's Berkshire Hathaway. The takeaway is simple. Owning SPY means you have a significant stake in these specific companies. Their fortunes will really steer your returns. And if we zoom out from individual companies to the sectors they belong to, the picture gets even clearer. If you add it up, over 46% of the entire fund is packed into technology. Then you throw in another 14% from finance. So let's be really clear. Buying SPY isn't some broad, fuzzy bet on the US economy. Nope. It's a very specific, concentrated bet on the continued dominance of American technology and finance. Okay, so we know what's in it. But the billion-dollar question is, how has it actually done? Let's pull up the report card and see what the numbers say. Looking at the last year, the fund has been really strong, delivering a solid return of more than 15%. Not bad at all. And that's not just a recent trend. If you zoom out and look at the 5-year average, you see some incredible consistency. We're talking an annualized return of just under 15%. That's serious long-term growth. And that momentum has just kept on rolling into this year with an impressive year-to-date return of over 18%. So yeah, historically, the performance has been robust and consistent. Now, returns are great, but you always have to talk about risk. And a key way to measure that is with something called beta. It might sound technical, but the idea is actually super simple. Beta just tells you how volatile an investment is compared to the market as a whole. A beta of exactly 1 means it moves perfectly in line with the market. Higher than 1, it's more volatile. Lower, it's less. That's all it is. So, what do you think SPY's beta is? Well, no surprise here, it's exactly 1.00. And that makes perfect sense, right? Its entire job is to be the market. So by definition, it moves with the market. It doesn't just follow the benchmark, it is the benchmark. Okay, so the performance is strong and the risk is, well, market risk. But nothing's free, right? Every investment has costs and potential downsides. So let's talk about the price of admission for SPY. One of SPY's absolute superpowers is its liquidity. And I mean, it's incredible. On an average day, nearly 80 million shares change hands. That number is staggering. What it means, especially for active traders or big institutions, is that you can get in and out of even a massive position almost instantly without messing with the price. That is a huge advantage. But, and this is a really big but, that liquidity comes at a price. And this right here is the critical trade-off. SPY's annual fee, its expense ratio, is about 0.09%. Now that's low, but there are newer funds that track the exact same index for as little as 0.03%. You might think, who cares about a few hundredths of a percent? Well, you should. Over 30 years on a $100,000 investment, that tiny difference can cost you more than $10,000. It really, really adds up. And of course, there are other risks to think about. You're exposed to the general ups and downs of the whole US economy. That heavy concentration in tech, great when things are good, but if those big stocks take a hit, so does SPY. It also has a slightly quirky structure. It's a unit investment trust, which is an older design that can sometimes cause tiny tracking errors. And finally, like all stocks, it's sensitive to whatever the Federal Reserve is doing with interest rates. All right, so we've covered what it is, what's inside, how it's performed, and what it costs. That brings us to the most important part, the final verdict. Is SPY the right investment for you? When you put it all together, SPY is still the absolute king for certain investors. If you're an active trader who needs that incredible liquidity to move in and out of positions fast, it's the top choice. Same for big institutions making huge trades. And, of course, if you've owned it for years, selling just to switch to a cheaper fund might trigger a tax bill that cancels out any potential savings. But for just about everyone else, the typical person who is buying and holding for the long haul, here's the bottom line. And it's a powerful one. You can find nearly identical funds that do the exact same thing for a third of the cost. And as we saw, that seemingly tiny difference can mean tens of thousands of dollars more in your pocket over your investing lifetime. And that leaves us with this one last thought. SPY is the original, the trailblazer, a titan of the industry. No doubt about it. But in the world of investing, original doesn't always mean optimal. So the real question you have to ask yourself is this. For your goals, is the original still the best?